Hi, I'm Michael Neuenschwander with Outlook Wealth Advisors. Welcome back to the channel. Today we're going to be talking about Roth conversions and IRMAA and how they interact, how to plan correctly. So to start off, let's talk about, well, what is IRMAA? Maybe you know exactly what it is, maybe you haven't really heard of it. It stands for Income-Related Medicare Adjustment Amount. But put simply, it says, how much do you pay for Medicare? So the more income you have, the more the government charges you for the exact same benefit as everything else. Love the way the system works, right? And so we're going to talk about, how do you either avoid it, plan for it, or at least make sure you don't get taken by surprise on it. Now, a few things we throw out when we talk about IRMAA and Roth conversions. So IRMAA, as we said, we need to make a distinction, a brief tax dive here, and it says IRMAA looks at your modified adjusted gross income. It says, okay, well, what is that? So it's take your gross income, add back things such as, the tax-free, if you have municipal bonds, you add back in the tax-free interest. If you have certain foreign tax credits, add that back in. So for many people, it may be about the same as your adjusted gross income, but again, for others, there are some things you have to add back. And says, well, how is that different than just regular taxable income? Well, most of us, if we're pretty astute on the taxes, maybe you know exactly what your tax bracket is or where your income falls and say, well, sure, if I'm married, I know the tax bracket for, the top of that 12% bracket cuts off at about $97,000. Hey, if the top of the 22% bracket, about $175,000, etc. Those are the numbers that most of us may know or at least have a feeling for. However, taxable income is after all your deductions. Modified adjusted gross income is before. So where many people make a mistake is thinking, well, hey, I'm going to do things that max out this particular tax bracket. Because you may have heard, hey, a good strategy for a Roth conversion or a good tax strategy is simply use up the tax bracket you're already in. And on the surface, that may make sense. However, if you're not paying attention to how IRMAA is calculated and that modified adjusted gross income, maxing out one tax bracket may actually put you just over the IRMAA thresholds. So how to plan correctly? You need to begin to consider, it's like one, we've done a whole separate video on Roth conversions and whether they make sense or where they don't make sense. So make sure you subscribe, check out those videos if you want a deeper dive specifically on Roth conversions. But when we talk about how Roth conversion planning interacts with IRMAA and modified adjusted gross income, you still need to think about what kind of tax bracket are you in today, based on whether you're still working or based on early in retirement or Social Security, pension, dividends, interest, what's going on today. Then what happens when you hit required distribution age? Because if you're not taking much out of your IRA or you're taking relatively little and those required distributions are going to make you take more, then that may change your tax bracket by the time you get to age 73 and beyond. And then you also need to look and say if you're hopefully fortunate enough where you're in a relationship, you got a spouse, you're married today. If something happens to one of you, then what happens to the taxes if one of you has to file as a single taxpayer? And the reason it's important to look at all three of those areas is to get an understanding of what makes sense so that you can strategically plan, one, should you do a Roth conversion? If you should, how much, and then also the timing of when it makes sense to do it. So understanding what your income, i.e. taxes, look like in all three of those areas is important. And now let's dig into, okay, so where does this IRMAA, come into play? So most of us says, sure, we know you can start Medicare at age 65. So, okay, great. I don't need to worry about IRMAA till I'm 65, right? Wrong. What really happens is they start looking at what did you make when you were 63, 64, and 65. So basically 2 years before you turn 65, the IRS and Social Security, they already know what's on your tax return. They're going to be looking at it to determine what do you pay for Medicare once you turn age 65 and beyond. And they do look at it every single year. So I want to be clear on that. If you're forced to pay IRMAA 1 year, doesn't mean you're paying it forever. Or if you don't have to pay it 1 year, doesn't mean you can't be forced to pay it, in the future. So it's every single year that they look at it. And when they look at that, there's really only a handful of reasons that they will ignore or reconsider things. So in that case, you can file here, make sure you got your note. This is called an SSA 44. So if that applied to you and it said, well, I'm going on Medicare now, I just retired, why are they looking at my income from 2 years ago? That's one of the scenarios they will reconsider it. So if you had a work reduction, meaning you went from full-time to part-time, you had a work stoppage, you retired, or you were married, divorced, or spouse passed away. Those are sort of the 5 reasons that the IRS and Medicare will give you a free pass, if you will, on your modified adjusted gross income. You'll notice I did not say that a Roth conversion was one of those options. So for every other year, doesn't matter why your income was higher. It could be you inherited property that you had to pay taxes on. It could be you took an IRA distribution, you had a big capital gain, whatever. If you don't have one of those 5 reasons on why they'll ignore your income, they're going to look at it, and if you're above the certain thresholds, then you have to pay more for Medicare. Now let's take a look at the 22% tax bracket, just in our example today. For a lot of married couples, they may find that their retirement income ends up in that 22% bracket. That generally runs from taxable income of roughly $97,000 all the way up to roughly $175,000. So it's a fairly good size range that for a lot of people, it says, yeah, we can have a pretty comfortable retirement if we have income in that range. And as you begin looking or you're having discussions about Roth conversions, saying, you know what? I think a Roth conversion does make sense. If we can move that money out of our traditional IRA accounts, we're heading off required distributions because there is no required distribution on a Roth. If you believe we're in historically low tax rates, which we've done several other videos talking about tax rates and tax strategy, but if you believe you're in low tax rates, well then voluntarily moving money out of your IRA into a Roth says you'll pay taxes on it today at today's tax rates in exchange for future growth being tax-free. Tax-free for you, tax-free for spouse if something happens, or if part of your plan is to leave a legacy or leave things to beneficiaries, it's tax-free for them for 10 years under the rules. They still have to take it out. So there may be lots of reasons why Roth conversions make sense, but this is really about, well, how much? So if we go back to that couple and they're in that 22% tax bracket, it says, well, if their ordinary income says, we need $125,000 to live on. So for most of their income is going to be taxed at 10 and 12%. Last little bit taxed at 22. So, well, if we're in the 22% bracket anyway, and a few years down the road, we're going to have required distributions, which are going to add to our income, that may still keep us in the 22% bracket. So great, we're not going up in taxes because of that, but we also feel in the long run, taxes get worse. Either there is a tax law change down the road when we have a new Congress, or something happens to one of them and that forces tax rates to go up because now the survivor's filing as a single taxpayer. So there can be lots of different reasons, but our belief is in the long run, taxes go up, and so therefore some Roth conversion, getting things to the tax-free side, makes sense for a lot of people. But if you take that and say, great, well, if we're in the 22% bracket, let's go ahead and max everything out. We're going to take our income all the way up to around $175,000, $180,000. We just want to stay in that 22% tax bracket. And if that's the plan, let's suppose they do the Roth conversion, they end up right at the top of the 22% bracket. Everything looks good for 2 years. And then down the road, they're going to get a letter in the mail that says, well, your taxable income was in the 22% tax bracket. However, your gross income puts you just above that IRMAA threshold. And because of that, you get to pay an extra amount for Medicare for both of you for 12 months, for 1 year. Now, in and of itself, the first level of IRMAA is generally not that expensive. At today's rates, figure an extra $90 a month per person for 12 months. So effectively about a $2,000 extra in tax. However, it may have been completely avoidable. It says if you had stopped that Roth conversion maybe a few $1,000s less, you wouldn't have been subject to IRMAA at all. So understanding the threshold between the top of the tax bracket by design is often just above the next IRMAA threshold. Same thing applies. What if you're saying, well, Michael, we're nowhere near the 12% or 22% bracket today? Well, guess what? Same thing applies for the 24% bracket. If your strategy was we're going to do a much larger Roth conversion, because that 24% bracket goes all the way up to almost $400,000, we're going to do a much larger Roth conversion. We're going to fill up that 24% bracket. Well, guess what? The top of the 24% bracket also puts you just past gross income of one more IRMAA range. And we said the first tier of IRMAA maybe isn't too bad. In reality, there's 5 to 6 tiers, and they can range from $90 extra per month per person all the way up to much closer to almost $400 extra per person. So we're talking Medicare charges in the range of $650 to $700 per month per person. So most of us would agree, that kind of range you'll definitely feel, if you will, at the end of the month, or every year. So it's important to simply understand when you're planning for a Roth conversion, it's a little more complex. You need to be a little bit more astute in understanding the difference between modified adjusted gross income, taxable income, and the overlap between tax brackets and those IRMAA tiers, as they're called. So these are the kind of things we help people plan for every day. So I hope this video has been informative to you, gives you a better understanding of a couple of the other details you need to understand in planning for Roth conversions. Now, if you have questions about whether you should even be doing a Roth conversion or how much or how it fits into your overall retirement plan, make sure to subscribe, or better yet, drop us a comment and feel free to reach out. So once again, my name is Michael Neuenschwander with Outlook Wealth Advisors. Thanks again for joining us on today's video.